AD4.
AB.
AD. Adam David.
All right. Make sure we take a look at that.
It might be system-wide because I know.
All right, I'll look at the items. Is there anything else you need?
The projector doesn't seem to be coming on either. Oh, there it is. It's on now. Okay, I think we're set.
All right.
Thank you. Okay, folks, while we wait for the projector to turn on. Okay. Couple of reminders. One is that your first quiz is a week from today. It's in the first 30 minutes of class. Let me emphasize again. First 30 minutes. So if you come in 15 minutes late, half the time is gone. So it's first 30 minutes of class. There will be class after the quiz. So don't leave if you finish your quiz quickly. Just hang in there. It's on, I think. I just okay. Is that better? Let me turn the volume up. That's about as loud as I can make it. So you can always move closer. I mean, look at the empty seats. So that's the other option. Okay? So it will cover everything through Wednesday's class. The second is make sure you get the company name that you picked into the master. Notice I hadn't asked you, have you picked a company? I'm going to assume you have. Enter the company name into the master spreadsheet, simply because I'd like to get a sense of the companies you're analyzing, because as we go through the class, I can draw on those companies then when I talk about stuff in class. So let's pick up where we left off. We were looking at a regression beta and what it tells you about a company. And the way I described this was, if you think about, being a doctor and a new patient walks in and you run this whole battery of tests, blood tests and everything else to get a sense of where that patient is, a regression beta is like your first introduction to your company's risk profile. And I left you with a question of choices. Choices you have to make when you run a regression beta. Because you look at any finance textbook, it looks pretty straightforward, right? There's a regression, there's a slope of the line, but there are choices you have to make. Choices about how far back to go, how to slice up the data, daily, monthly, weekly, what index to use, and even things like what do you do with dividends? Because prices change every day, but dividends don't arrive every single day. They arrive only once a quarter if you're a US company, maybe once every 6 months for some European companies. So let me make the choices for myself because I wanted to run this regression for Disney. So the first thing I decided to do was I decided to go back 5 years. There's no right answer here. Your why 5. I would never go back more than 5 years. The reason being I'm getting a very different company than the company I'm seeing today. Would I use a period less than 5 years? Yes, if my company did a major acquisition 2.5 years ago, maybe it makes sense to look at just the last 2 years. So when you make that choice, think about your company. There is no rigid right answer. You need enough time to run a regression, so you don't want to run it over 3 months or 6 months. But 2 years, 5 years, I leave that choice to you. In the case of Disney, I decided to go back 5 years in November of 2013. Incidentally, if I were looking at Disney today, I'd probably go back only 2 years. You know why? What's the big change that has happened at Disney over the last 2 years? Disney Plus has changed the company in terms of what kind of company it is. So I went back 5 years, and because I went back 5 years, I had the luxury of using monthly returns. You see why if you go back only 2 years, you might use weekly returns? Because with 2 years, you have only 24 months of data. That's not enough data. But with 5 years, I could use monthly returns. Again, the choice is you don't want to go daily. Daily never works in any kind of regression. weekly or monthly. Which one you will pick depends on whether you're looking at 2 years or 5 years of data. So 5 years of monthly data. Staying with the conventional practice, even though it might not be right, and we'll talk about why it might not be right, I use the S&P 500 as my index. It's the way every beta estimation service in the US estimates betas for US companies against the S&P 500. And remember what I said about the S&P 500. It's got only 500 stocks, which is a minus, right? You want every stock out there. But the 500 stocks it picks are the largest market cap stocks out there, which means in terms of market value, you got 80% of the market value of the US equity index in that. And then I proceeded to compute returns. You're saying, what's the big deal, compute returns? There are two components to returns on stocks. One is the price change, and the other is the dividend. So every month for 60 months, I computed the change in prices. So if you take a month like December of 2009, Disney's stock price went from $30.22 to $32.25, an increase of $2.03 per share. You divide that by 30/22, you get the price change return, the price appreciation. But during that month, it happened to be an ex-dividend month. You know what ex-dividend stands for? It's basically the day by which you got to buy the stock to get the dividend. So when you look at dividends, it's not the actual check being mailed out that drives when you get returns. It's the ex-dividend month, the month in which the dividend is declared and you lay claim on it. The ex-dividend month, they got a 35-cent dividend. You add the $2.03 to the 35 cents, they made $2, and they being the investors in Disney in that month, made $2.38 per share. You divide by the starting stock price. Returns are always computed based on what you paid up front. And the percentage return on Disney for that month was 7.88%. Excuse me. It was a good month. Now that's how I got the returns for Disney. That was the easy half. For the S&P 500, I got the index at the end of November, and so that was easy, getting the index levels. The index was up from 1,095 to 1,115. But the S&P 500 is the 500 largest market cap stocks. Some of them, like Disney, paid dividends during the month. Not all of them paid dividends in the same month. Yes? I can't get Zoom to work. There's something wrong with the system. It's not letting me get in. You guys can try as well. Remember, you get that phone option? The phone option seems to have disappeared. Sometimes IT works in mysterious ways. So, but the class is being recorded on media side, so I'll send out an email afterwards. It's really, unfortunately, I don't have a choice today. So the dividends, though, on the index come from looking at the stocks that do. Luckily, S&P maintains a website where they actually report dividends by month. Bloomberg carries the dividends as well. The dividends collectively on the S&P 500 during December of 2009 is 1.68. That's in index units. So if you look at the total return, change in the index plus the dividend, the percentage return on the index that month was 1.78%. None of this is rocket science. You just need the level of the index, you need the dividends. I did this every month for 59 months. You know why it's only 59, right? I have 60 months of data. The first month, you need the change in the price. So 60 months of data yield 59 months of returns. So think about this as an Excel spreadsheet. I have 59 months of returns on Disney and 59 months of returns on the index. I ran a regression. There was a time when you actually had to physically calculate the parameters of a regression. We live in good times, right? You open up Excel, you have 2 columns, you run the regression. But let's go back to basics. When you run a regression between 2 variables, in this case, your dependent variable is Disney, your independent variable is the S&P 500. Here's what you're doing. You're taking every month of data. So each of these blue points is a month of data. Just like December of 2009, every month is plotted there. So you have 59 months if you want to count. And then you have a best fit line. That's what a regression is. Does anybody remember enough of your statistics to tell me statistically how we find the best fit line? What is the criteria we use to find the best fit line? You could try to eyeball the data, but you'd go crazy. What is the best fit line? Yes?
We reduce the error between the points.
Is it the error? Because the errors can be both positive and negative, right? So you can't minimize the error because, you know, you wouldn't get, you have to square the errors first. You minimize the squared error. So basically you take the distance between each point and the line. Think of how much more work regressions were before computers came along. People actually used to use, you know, rulers to measure the distance, square the distance, and look for the minimum squared distance line, the line that minimizes the squared distance. So it's called ordinary least squares regression. That's the best fit line, right there. And if you look at that line, here are what the parameters look like. The point at which it crosses the x-axis is called the intercept. And it's 0.0071. File that away for the moment. We'll come back and look at what it tells us about Disney as a stock during the period of the regression. The slope of the line is 1.2517. What does that tell us? If you believe your finance textbooks? That is the beta for Disney. You're saying, what are these in brackets below? When you run a regression in statistics, what are you trained to do? You show the coefficients, but then to tell the world how uncertain you are, you put your standard errors below the coefficients. The standard error on my intercept is 0.0053, and on my slope is 0.10. We'll come back and talk about what that might be useful for, but this is a purely statistical output. I've taken returns on Disney, returns on the S&P 500, found the best fit line based upon those 59 months of returns. And there's the output from the regression. Any questions, statistical questions, or the setup questions on how you run the regression? Because if you had to do it from scratch, it's not a big deal. You have to collect the data. It's a pain in the neck because you've got to enter each month's numbers. You've got to compute the returns. But with the tools we have, you could do this from scratch. You don't need Bloomberg. You don't need a beta estimation service. You could run a regression yourself. Now let's talk about what this regression output tells us about Disney as a company. Let's start with the intercept. The intercept was 0.712%. Everything was run in percent, so the intercept is in percent. It said 0.0071, but in percentage terms, that's 0.712%. Is that good? Is that bad? Well, I can't pass judgment until I come up with a comparison. And if you remember last session, I talked about what that intercept should have been if the CAPM were the right model. In other words, if this stock did exactly as predicted, here's what the intercept should have been. There's a risk-free rate, 0.50% during the period. So that's like a T-bill rate every month. The average T-bill rate is 0.50%. A T-bill rate is an annualized rate. So when I tell you the T-bill rate is 0.5%, it's annualized over the year. These are monthly returns. To be consistent, I need to come up with a monthly risk-free rate. So here's what I'm going to do. I'm going to take the 0.5%. I could play games and come up with a compounded effect. It's not going to make much of a difference. On a monthly basis, the risk-free rate was 0.042%. I know we're layering abstractions, but hang in there with me. That's what the risk-free rate was over the 60 months of this regression. If you multiply that risk-free rate times 1 minus the beta, remember the beta that came out of the regression was 1.252, I come up with minus 0.01%. You're saying, what the heck does that even tell us? If Disney had done exactly as predicted during the 60 months that I ran this regression over, the intercept should have been minus 0.01%. The actual intercept was 0.71%. That difference, 0.71, minus what the intercept should have been, is 0.72%. That's called Jensen's alpha. It's a measure of how well or badly your stock did during the period of the regression. You're saying, well, all this work for 0.72%, that's a measly little number, right? But that's per month. If you're making 0.72% more than expected in a month, On an annualized basis, if you make that every month, it's the return you'd have made on an annualized basis over and above what you needed to make would have been 9.02%. Let's step back. During this period, Disney did 9.02% better than expected, adjusting for risk and adjusting for the market. Here's one way to think about it. If the market was up 25%, given that Disney's beta is 1.25, you'd expect it to be up about 30 or 31%. Disney made that plus 9.02%. It's an extra return. What does that tell you? You wish you'd owned Disney between 2008 and 2013. Jensen's alpha is a post-mortem. It's not telling you whether you should be investing in Disney in the future, but it tells you, I wish I'd invested in Disney in the past. Any questions about the mechanics here? So the regression delivers the intercept. You compare to what it should have been by looking at the risk-free rate times 1 minus beta. That difference is called Jensen's alpha, and you can compute this for every single stock in the market. Let's say you do. You start with A and you work all the way down to Z. You compute the Jensen's alpha for every single stock between 2020 and 2022. What should the average Jensen's alpha across all stocks be? It should be 0. Tell me why. It's been a good 2 years, right? Why can't the Jensen's alpha for all stocks be positive? It's been a good 2 years.
It's a comparison between the firms. So some of them outperform, some of them must.
In other words, the market can't beat itself, right? Collectively, this is a market-adjusted number. The market's up 50%. I'm scaling every company up to make sure it's delivering returns relative to the 50%. If the market is down 20%, I'm scaling everything down. It's a risk-adjusted, market-adjusted measure of performance, which means the average Jensen's alpha, it's actually a weighted average based on market cap, across all stocks should be roughly 0. If you go back 2 years and you look at stocks you could have invested in, you could have invested in Tesla 2 years ago at about 1/5 of its current price. So what kind of Jensen's alpha are you going to get for Tesla if you look at the last 2 years? Immense, 90%, 100% a year. And while you're celebrating looking at Tesla, remember the average Jensen's alpha across all stocks should be 0. For every Tesla, there's got to be an anti-Tesla, right? Life's too short for regrets. I know people are out there saying, I wish I'd bought Tesla 2 years ago. And while you're wishing you bought Tesla, be glad you did not buy the anti-Tesla, which was down 90% over the last 2 years. Stocks can't all be winners. For every winner, there's a loser on a Jensen's alpha basis. So when you look at Jensen's alpha, even if it's a small positive number for your stock, celebrate. You're on the right side of the divide, right? Because about half of all stocks should have negative Jensen's alphas. Any questions on Jensen's alpha and why it should be roughly 0 across all stocks? Now let's get back to Disney. Disney had a positive Jensen's alpha, right? It was up 9.02%. Over and above what it needed to make each year for those 5 years. I'm going to play the role of Bob Iger, and you're going to be Disney shareholders, and it's 2013. I come up in front of him and say, look guys, I've done a really good job for you. I've delivered 9.02% more than expected over the last 5 years. That must mean we're doing a good job as management. We should all get a bonus. You see where I'm going? When you see a stock with a really large positive Jensen's alpha, does that mean the management of the company did a really good job? Or could there be another explanation? What if I told you that the Jensen's alpha for oil stocks right now, across oil companies, is ExxonMobil, Royal Dutch, is hugely positive if you go back 2 years. Does that mean that ExxonMobil's management did a really good job? What caused the returns over the last 2 years to be positive? Oil prices are back up to $100 a barrel, right? You see where I'm going? When you see a really large positive Jensen's alpha for a company, it might be that the management of the company is doing a really good job, but it could also be that the entire sector had a really good period. So before I reward Disney's management, what do I need to do? I need to check the average Jensen's alpha for entertainment companies. If it's 11%, at 9%, Disney actually underperformed. If it's minus 3%, then Bob Iger is right. He should get a reward because he delivered positive returns in a period where stocks were doing badly. If you go to my website, I report average Jensen's alphas by industry group. The reason I do that is when I compute the Jensen's alpha for a company, I need something to compare to. I can't just compare to zero. I can't just reward companies with positive Jensen's alphas and punish companies with bad Jensen's alphas, because a great deal of what you see for a stock is not in the control of management, especially as companies mature. One final question. I could do Jensen's alphas for you right now for every single stock listed globally. And as an investor, you might say, can I use that number? Because you didn't own Disney for the last 2 years, the last 5 years. But if I tell you that the Jensen's alpha for Disney is positive, one question that investors have is, what does it tell me about whether I should buy Disney right now? Anybody want to try to address that question? When you see, so take Tesla, right? Jensen's alpha is huge for the last 2 years. Does that mean you should buy Tesla, sell Tesla, or does it tell you nothing about Tesla? Anybody argue that you should buy Tesla because of it? I'm sorry? It tells you nothing. And if you say that, you're saying you never look at past return. But let's be completely honest. None of us is capable of that degree of dispassion, right? I mean, when I show you Tesla versus Kraft Heinz, part of you is saying, look how well Tesla has done. So if you believe that there is no correlation between what's happened in the past and what's going to happen in the future, you're going to say, it tells me nothing. If you're a contrarian, what does it tell you? That you should actually be buying the stocks with the worst Jensen's alphas, because as a contrarian, you're saying, if the market has priced down these companies so much, there must be a reversal. So if you're a contrarian, you would actually avoid stocks with positive Jensen's alphas. And in markets, for every contrarian, there's a momentum investor. You know what momentum investors believe? That the stocks with momentum are more likely to do well in the future. So I'm not willing to argue that there's no correlation, but what you assume about the correlation will reflect your investment philosophy. If you believe in market efficiency, you're going to say it tells me nothing. If you're a contrarian, you're going to do the opposite of what Jensen's alpha is telling you to do. Take the positive Jensen's alphas and you're going to sell them, and the negative Jensen's alphas and buy them. And if you're somebody who believes in momentum, you might go with stocks with positive Jensen's alphas, hoping that they continue to deliver returns. Any questions about Jensen's alphas? Yes? Because what you're doing when you run these regressions, you're acting like an investor with a 1-month time horizon. Start of every month you buy the stock, at the end of every month you sell the stock. So while the risk-free rate we use when you do cost of equity is always the long-term T-bond rate, when you look at Jensen's alpha, you're looking at a short-term rolling rate, because you're asking what could I have made on a risk-free basis on a monthly investment. And it's always passed, right? Basically it's a risk-free rate over the last 5 years. For most of you, you know what that number is going to look like, right? If you're doing things in the US, the average T-bill rate for the last 3 or 4 years has been close to 0. So your risk-free rate is going to be 0, which effectively means your Jensen's alpha can be compared to 0. And you're going to very quickly be able, the intercept can be compared to 0. and you can very quickly pass judgment on your companies. Now let's move on to the slope. Now when you look at beta estimation services, now Barra, S&P, FactSet does it. And they sell these betas to companies that use betas, the investment banks, consulting firms. So let's play a little game. Let's assume you are working at Goldman Sachs. You're an M&A banker. You have to value a target company, and you have to get a beta for the company. There's no way you're running a regression from scratch. It's not even in your top 50 list of things to do. So you decide to use Barra, and I'm your estimation service. And let's say Disney is the target company. Who's acquiring it? Apple with petty cash. You have $200 billion. You can acquire just about anybody you want. So you call me. You probably won't. You text me or email me, but let's say you call me. Say, I want a beta estimate for Disney. And let's say I have that regression I showed you just now. If you ask me for a point estimate of Disney's beta, just one number, what's the number I'm going to give you? I'm going to give you the 1.25 that I got from the regression. I'm going to try to hang up the phone really quickly because I'm afraid of your follow-up question. Because remember, if you remember your statistics, that's your point estimate. But I also gave you the standard error as 0.10. So let me follow up and say, with 67% confidence, which is not a whole lot of confidence, give me a range on that beta. What's the significance of the 67%? Plus or minus one standard error, right? 1.25 minus 0.10, 1.25 plus 1.10. My range with 67% confidence would be 1.15 to 1.35. You up that to 95% confidence, that's two standard errors. My range will go from 1.05 to 1.45. Do you see where I'm going? When services claim betas as facts, they're lying. Betas are estimates, and they come with ranges. Might as well be open about it, because there are some companies we look at the range and say, I'm not using that beta, because the range can be huge on your beta estimate. So the slope of the line tells you what the beta for your company is. The standard error allows you to come up with a range on your beta. In case you're wondering whether 0.10 is a typical number, a high number, it's actually in the low end of what a typical standard error is for a beta estimate for a company in the US. The median standard error for a beta estimate in the US is between 0.2 and 0.25. Think about it. When you see the beta for a company, you should be adding plus or minus 0.5 on each side to get a range on the beta. That's typical for a company. 0.10 is actually the lower end of the spectrum. So most beta estimates come with pretty big ranges. I'm starting to dig a hole for beta so I can bury them. Here's one of the holes. If you run these regressions right, you're going to get a big range on your beta. And this is not a statistical problem. It reflects the fact that much of the risk in individual companies is company-specific risk. Don't try to fix the problem. Don't try to bring in statistical tricks to make the standard error smaller. It reflects a reality, which is much of the risk in a company is company-specific risk, and only about a third, maybe 40 or 50% in a typical company will be explained by the market. So we've looked at the Intercept. It tells you how good or bad Disney was as an investment. You looked at the beta. It gives you a range. Let's look at the R squared. The R squared for this regression was 73%. What does that tell you? It tells you that 73% of the variation in Disney's stock price was explained by the market. Let me repeat that again. 73% of the variation in Disney's stock price was explained by the market. But flip that around. If 73% is explained by the market, 27% of the variation is not explained by the market, right? Remember that divide we had with the risk and return models? Risk you can diversify away and risk that you cannot diversify away. We now have a breakdown of how much of the risk in Disney can be diversified away. 27% of the risk in Disney can be diversified away. And here's a follow-up to that. I've been computing these R squares now for companies going back a long time. And starting in 2008, those R squares you see for companies collectively have increased. The average R squared across US companies has increased dramatically. Not just US companies, global companies, has increased dramatically over the last 13 years. By my estimate, probably doubled. Typical US company used to have an R squared of about 25%. Now it's closer to 50%. So what's happened since 2008 that explains the higher R squared? What am I saying? I'm saying more of the variation in an individual company is now explained by the market than used to be the case. Why might that be? What do you have in a macro crisis? Go ahead. Well, I mean, I think index funds are easy to blame, but how can they increase the R squared across companies, right? Company-specific risk is company-specific risk. Individual companies have good news and bad news. Having index funds around doesn't make good news and bad news go away, right? You still have earnings reports. But it looks like the effect of those in the variance is a lower percentage now than it was 13 years ago.
Could it be that there's a lot more money following the market, so as a result?
That's a variation of the same index fund story, right? That should actually just increase momentum in both directions. So when you have an earnings report that's good, your price should go up even more. So it's not just macro news that you'll see the bigger effect on, but also on micro news. Have you ever seen what happens to markets during a crisis? We're in the midst of one right now, right? I mean, take a day like Thursday or Wednesday. Okay? Wednesday, market was down in the US, it was down in Europe, it was down in Asia, it was down in Latin America. It's down around the world. Friday, stocks were up in the US and they were up in... When you have a crisis, stocks start to move together, because right now nobody's asking what will happen to Netflix subscribers next quarter. People are asking what will happen to Ukraine tomorrow. When you have macro crises, the correlation across stocks tends to go up. Because everybody's worried about the same thing and it's got nothing to do with the individual company. 2008, I think, was the time we realized how much we were connected. Maybe it's always been true, but in 2008, in that last quarter, you started to see companies move together in ways we hadn't seen until then. And it's continued since, right? We've had crisis after crisis. After 2008, we had the Greek crisis. Basically, you can go through, and it's every 2 or 3 years, there's another crisis. There's Brexit. Now it's Ukraine. And I guarantee you, 2 years from now, there'll be another global crisis. You think, hasn't this always been the case? 50 years ago, if you had a crisis in Asia, it didn't even spread across Asia, it was actually specific to the country. Welcome to globalization. We're all connected at the hip. And what I think it's done is it's increased the correlation across stocks and made them all move together. The first thing that people in Mumbai check before the market opens is what did the S&P 500 do yesterday? Because remember, yesterday for the S&P 500 and opening for the Sensex are separated by just a couple of hours. But there's also a follow-up to this. If more of the risk for every stock is coming from the market, remember when you do fundamental analysis, the old value investing, what were you told? Just pick a company, do all your research, and if you do your research right, what does it matter what the market does? That's terrible advice now. Because that advice also said, just buy 4 or 5 good companies. And if you buy 4 or 5 good companies, you'll be able to ride out the crisis. As more and more risk becomes macro risk, there's less and less payoff to doing company-specific research, right? The essence of value investing, fundamental investing, is if I do my research on individual companies, I can get the company-specific risk part right, and I'm going to be rewarded. I'm not saying it's gone away, but the rewards have become far lower because we're all globally connected. One more point about R-squares. R-squared tells you how much of the risk in your stock comes from the market. So I'm going to pose a challenge to you. Let's suppose you're an investor, but you're a diversified investor. That's going to be significant in how you make this choice. So you run a mutual fund. And I come to you with two companies which have exactly the same beta but different R squareds. You see how that can be? Beta is a measure of the risk in your company relative to the market. You're saying if they have different R squareds, how can they have the same beta? Because the total risk in companies varies widely. So let's assume you have two stocks, same beta, different R squareds. One is an R squared of 25%, Amgen, and the other is an R squared of 73%, Disney. And you're trying to decide which stock to pick. And let's assume their earnings, their cash flows, their growth look very similar. So this is going to be your key divider. Should I go with the high R squared stock or the low R squared stock? As a diversified investor, would you pick Disney because it has a higher R squared? How many would pick Disney because it has a higher R squared? Okay. How many would pick Amgen because it has a lower R squared? And how many would be indifferent between the two? Keep your hands up because your answer is the right one, and let's see why. Let's assume you pick the higher R squared stock. What happens to the risk that's firm specific? You're going to diversify it away. So after you're done diversifying, the firm specific risk goes away, whether you buy 73% R squared or a 25% R squared. Remember, I said the earnings and the cash flows are the same. And if you're a diversified investor, you don't care because as you diversify, company-specific risk goes away in your portfolio. So diversified investors shouldn't even look at R squared because it doesn't matter. They're going to get rid of the firm-specific risk. But let's say this is your eccentric uncle. Each of us has one, right? I mean, they're paranoid. They don't trust mutual funds. They say, I'll buy only 4 stocks. And you can't talk them out of it. If I am an undiversified investor and I've decided I'm going to buy only 3 or 4 stocks, now would your answer be different? Do I want to go with the higher R squared stock or the lower R squared stock if I have only 3 or 4 stocks in my portfolio? What do you think, Mansi? The lower? Okay, so let's see what happens. I have only 4 stocks. They're all low R squared stocks. You're taking on risk that you're not going to get rewarded for, right? When you buy a low R squared stock and you're not diversified, you're exposing yourself to risk that you're not going to get rewarded for. For God's sakes, if you buy only 4 stocks, don't make them Zoom, Peloton. Basically you buy these low R squared stocks because you're asking for almost disaster to happen to you because you're exposing yourself to risk that is not rewarded. Buy companies that move with the market. In fact, if you can fool your eccentric uncle, get him to buy that stock that mimics the S&P 500 index. Say, this isn't a good stock, buy it. It'll have an R squared close to 100%. Because if you're not diversified, the worst thing you can do is to hold stocks with low R squareds, expose yourself to that risk.
My question is that if I'm an undiversified investor and if I have low R squared, that means that I am less exposed to the market risk and more exposed to
Yeah,
the market
exactly, and that's a problem. Because you're exposed to them, you're more exposed to companies. If you buy low R squared, you're more exposed to company-specific risk, less to market risk.
But if I'm just having 3 or 4 companies, then I would do my analysis where
Okay, so now you're saying I can compensate for the fact that I have all this risk that I'm not rewarded for because I can pick such good companies that I can make the company-specific risk work for me. That's the argument that people with concentration make. But you can already see the dice are already loaded against you because you're taking risks that you're not going to get rewarded for, and now you got to overcome all of that risk with your stock picking. This is why in the long term, concentration often ends up with terrible returns. Because picking really good stocks is difficult, and picking 3 or 4 of the stocks that are the very best stocks is even more difficult. If you're going to pick stocks, you know what I'd suggest? Pick about 25 or 30. Don't pick 4 or 5. Spread them across sectors. Don't make them all tech companies. I'm not stopping you from picking stocks. I'm saying it's hubris to say I found the 3 or 4 best stocks in the market and I'm going to put all my money in there, even though they're low R squared. Because you have too much of a barrier to overcome because of all that risk you're not going to get rewarded for. Any other questions? Now, until the late 90s, for this class, I would make people run the regression from scratch, just like I did for, and it's not a big deal. You can go to Yahoo Finance, get the stock prices for your company. You can even get dividends on your company. You can get the S&P. I can give you a source. In fact, I'll send you the source if you want to run the regression from scratch for yourself. So you enter the numbers in an Excel spreadsheet, compute returns, run the regression. And Excel has its own regression package you can run. You can get the slope, the intercept, the standard errors, etc. But I think it was about 20 years ago that we got the first Bloomberg terminal at Stern. It's hugely expensive, right? I mean, it's like $100,000. There's a reason Michael Bloomberg is worth as much as he is, because every Bloomberg terminal is like a cash machine that keeps on giving. The nice thing about a Bloomberg terminal is you don't have to run a regression from scratch, because you go to Bloomberg, you find your company, and they send you the directions on how to do this. After you find the company, if you type in beta, you get a beta regression for your company. Remember, Bloomberg is not doing anything magical. It's doing what I did with an Excel spreadsheet, but it's doing it for you. So after I ran my Disney regression with 5 years of returns against the S&P 500, I went to Bloomberg, I found Disney, I typed in the word beta, and the initial regression I got was a 2-year regression, weekly returns, because that's a Bloomberg default. But the nice thing in Bloomberg is I can change the weekly to monthly and the 2 years to 5 years. So basically what this is exactly the same regression that I ran, but I'm letting Bloomberg deliver the results. We're looking at the same period, same stock, same index, all monthly returns. Our numbers should be exactly the same, right? So I'm going to point to the numbers which were very close, and then point to one number which wasn't, and then we'll talk about why Bloomberg beta regressions might not deliver the same results as you would get if you ran a regression from scratch. So let's start with the numbers that are similar. The raw beta is very close, right? I got 1.251, they got 1.247. Rounded, we both have betas of 1.25. That's good. The R squared, 73.4%. My R squared was 73%. That's good. I'll come back and talk about the adjusted beta. Standard error of the beta, 0.099, 0.10. I got a standard error 0.10. Again, we matched up. So the beta, the R squared, the standard error of the beta match up. But if you look at the intercept, they call it alpha. It's really the intercept. The intercept they got was 0.60%. Mine was 0.71%. Incidentally, Bloomberg is very casual about decimals and percentages. The intercept says 0.599. It's not 59.9%, it's 0.599%. So 0.60% versus 0.71%. And you're going to notice this on your regression as well. Your betas are going to be close. Your R squares are going to be close. Your standard error is going to be close, but the intercept might be off. More for some companies than others. And here's the reason. When I ran my regression, I ran it with returns, including dividends for both my stock and the S&P 500. Why? Because it's the right thing to do. Because if you're an investor in a stock, it's not just price change, but also dividends that count to your returns. Bloomberg beta regressions are run with just price appreciation. Why? It's easier for the computer, right? Dividends are a pain in the neck, once every 3 months, once every 6 months. They're all price appreciation on both the stock and the market. It's not the right thing to do, but you can see why Bloomberg's cutting corners. Saying, what's the big deal? The number that you take out of this is just the beta, and it's pretty close. We're going to run it with just price appreciation. And most of the time, you're going to be okay. So if I take Facebook and Amazon and Netflix and Google, the regressions are going to be. But if I took a bank or a real estate investment trust, do you see why my Bloomberg beta regression might be very different from my own regression? What do banks and Reits have in common that's going to throw off the regression? They pay big dividends. Half your returns come in the form of dividends. If I ignore them, I'm actually getting a very deceptive looking beta because I'm ignoring a big chunk of my returns. I'm not going to ask you to redo the regression because of this, but just be aware of it. If you have a high dividend paying stock, your beta regression that you get from Bloomberg might be a little off because they're ignoring dividends. you're going to be able to get this page for your company. I've already talked about what the raw beta is, the R squared, the standard error of the beta. But I'm also going to talk about the adjusted beta, because you're going to see this show up for your company as well. In fact, when Bloomberg reports a beta as a summary on the description page, it reports the adjusted beta. And when I say adjusted beta, what vision comes to mind? I'll tell you what comes to my mind. A room full of Bloomberg analysts sitting there looking at the regression beta and adjusting it for things like dividends and debt and fundamentals. Dispel that notion right away. I'll tell you what the adjusted beta is, not just for Disney, but for every single company that Bloomberg estimates betas for. It's 2/3 times the raw beta plus 1/3 times 1. Let me repeat that again. The adjusted beta, if you don't believe me, try this on your company. The adjusted beta will always be 2/3 times the raw beta plus 1/3 times 1. Saying, what the heck are they doing? If your raw beta is 1.8, your adjusted beta will be 1.53. If your raw beta is 1.5, your adjusted beta is going to be 1.33. If your raw beta is 0.6, your adjusted beta is going to be 0.73. So tell me, what's happening here with the adjusted beta? What's Bloomberg doing? It's taking the regression beta and moving it towards 1. What's so magical about 1? It's the average beta across all companies. Bloomberg's trying to be really helpful, saying, look, over time, companies will start to look like the market. So here's what we're going to do. We're going to take your regression beta and move it towards 1, to which your response should be, please stop helping. Because these weights, 2/3 and 1/3, are being used for every single one of the 40,000 publicly traded companies that Bloomberg reports betas for. There must be magic weights to work for every company, right? So early in this process, almost 20 years ago again, I called Bloomberg, not the mayor, but the company. Maybe I should have called the mayor. I'd have got the answer. And I said, look, I'd like to talk to somebody about this weights you're using to come up with the adjusted beta. And the person at the switchboard said, let me put you in touch with the beta calculation guy. There's actually a guy at Bloomberg whose life it is to maintain this page. Imagine how exciting his life must be. They must keep him locked up in a basement room and feed him through a hole in the wall because he was pathetically grateful to get a call from the outside world. He comes on the phone and says, I'm so glad you called. I have all day to answer your questions. I didn't have all day to ask him questions, but I was worried if I hung up the phone too soon, he might do something rash. So after about 5 or 10 minutes of paying compliments to how nice it was to have a Bloomberg terminal and this adjusted beta, I hit him with a question. I said, why 2/3 and 1/3? He said, 2 minutes of silence. Like, and your paper's being rustled, terminals being turned off and on. I said, the 2/3 and 1/3 that you used to get a beta calculation. He says, I don't know, it was here when I got here. I said, what? He says, I was hired 2 years ago. It was already here, don't blame me. I'm not blaming you, I just want to know where you got the weights. He said, I don't know, here when I got here. You know how often that's going to be the answer to questions you ask once you start working? Why do we use the 6% risk premium? I don't know, it's here when I got here. When did he get here? 1979. It's amazing how much in corporate finance is embedded because this is what we've always used. Why do you use a small cap premium? Oh, because that's what we've always used. Here when we got here should never be the answer to any question in corporate finance. I'll tell you in my email later today, I'll give you the original source. It's a paper written in 1971 about betas at companies. And what this paper did was it looked at betas for US companies, about 100 companies, and they estimated betas for every year for 10 years. And over time, they chronicled that betas for companies tend to move towards 1 with roughly, guess what weights? 2/3 and 1/3. That was in 1971 with 100 companies. And that then got embedded somehow in practice. In fact, we know exactly how it got embedded. This paper showed up in one of the academic finance journals, Journal of Finance. And one of the editors of the journal was a guy called Bar Rosenberg. He used to teach at UC Berkeley. Until in the early 70s, Bar left Berkeley and he started a firm called Barra. Barra is now one of the leading services. It's now owned by Morgan Stanley. It's one of the leading services for estimating betas. And when he created Barra, guess where he went looking for ideas on how to come up with better beta estimates? He's looking through the journal. Oh, there's a nice paper. Let's use that. That was in 1974. And since then, it's become so embedded in practice. Every service does this. They take the regression beta, they move it towards 1. And the intuition makes sense, right? Companies, as they get bigger, will tend to get more diversified. But the weights make absolutely no sense. In fact, all they're telling you is which direction 1 is, in case you have trouble with that. But in case you have trouble with that, what the heck are you doing using betas in the first place, right? You're too dangerous to be around numbers. There's nothing adjusted about the adjusted beta. There's nothing predicted about predicted betas. These services will give these fancy names for moving the beta towards 1. It's just a regression beta move towards 1. So run this page for your company because you're going to get a beta from the page. So let's build on this regression beta. I don't quite trust it, the 1.25, but let's say that is the regression beta for Disney. Let's see how we use this to come up. Remember, the entire objective here is to come up with a hurdle rate? We're getting closer. The risk-free rate is a risk-free rate in whatever currency you work with. And in November of 2013, I was working in US dollars. So my risk-free rate was the T-bond rate on that day, 2.75%. If you were doing this today, obviously it'd be like 1.94%, 2.75%. The equity risk premium for Disney reflects where they do business. It's not just that it's a US company, it's a weighted average, 5.76%. The beta came from the regression, and I'm going to take it as the beta for the company. Risk-free rate plus beta times risk premium gives me an expected return of 9.95%. If you've taken a finance class, you do this calculation over and over again. And after a while, you don't even realize why you're doing it or what it tells you. But let's put some flesh on this number. Let's get some intuition driving this number. What does this 9.95% tell you about Disney as a company? First, I'm going to make you play the roles of potential investors in Disney. You haven't invested in Disney yet. Potential investors in Disney in November of 2013. I've done the number crunching for you. I've come up with 9.95%. And I'm going to read a couple of statements to you, and you tell me whether this is a fair description of what the 9.95% means to you as a potential Disney stockholder. 9.95% is the return that you can expect to make in the long term on Disney if the stock is correctly priced and the CAPM is the right model for risk. How many qualifiers did I put in that statement? Let's go through. You can expect, no guarantees. Long term, don't come to me 2 years from now and tell me you didn't make 9.95%. If the stock is correctly priced. I've added 5 qualifiers in one sentence. I'm a very lazy person. When I had 5 qualifiers, so this should be a, you don't use this in your quiz as an indicator of true or false questions. When you had 5 qualifiers, usually it's because so this statement is technically true, but it's error. It means when you read that, you say, well, so 9.95% is the return I can make if I believe that everything is correctly priced and the market is efficient. In the long term. So if you're a believer in efficient markets, this is the return you can make. And if you're a believer in efficient markets, if you want to make a higher return than 9.95%, what do you need to do? Buy a stock with a higher beta. That's basically it. Everything is driven by how high the beta is. It's not a statement I like because the other class, as you know, that I teach is valuation. There, I have to start off with the presumption that markets make mistakes. And here's what the 9.95 then tells me as somebody looking at stock saying, is that a cheap stock, is that an expensive stock? It's a return I need to make on Disney in the long term for me to break even on my investment. I've suddenly become a very needy person, right? The T-bond rate is only 2.75%. Why can't I settle for 2.75% when I'm investing in Disney? Because if I wanted to make 2.75%, I'd buy a T-bond. Why would I expose myself to the danger of Disney? 9.95% is the return I need to make on Disney for it to be not even a good investment, just a neutral investment. So let's follow through. 9.95% is the return. And so both these statements are right. The first statement is the statement you'd make if you believed in efficient markets. The second statement is the statement you'd make if you think you can actually pick stocks. So let's say you're the analyst. You think you can pick stocks. You go do your own research on Disney. You collect data on the management and the company, the financials. And based on your research, you conclude you can make a 12.5% return every year on Disney. So this is the return you think you can make based on your research. 9.95% is the return you need to make on Disney to break even. If you're the analyst, are you going to put a buy recommendation or a sell recommendation on this company? What? You'd put a buy because you can make more than you... Do you see why, if you're in equity research, I've heard a lot of equity research and say, I never use the CAPM because I need to pick stocks. I've never understood that. What does that mean? You know how equity research reports run, right? They'll have a price today, they'll have a target price. I've never understood what I'm supposed to do with it. I should be grateful that the target price is higher than the price today. That's a minimal standard. But let's say that my price today is $10 and my target price in 5 years is $15. That's good, right? 50% return over 5 years. But a 50% return over 5 years works out to like 9% a year. What's the next question I need to answer? Is that enough? And to answer that question, what do I need? I need something to compare it to. The CAPM doesn't tell you what stocks to buy and what stocks to sell. It just sets up benchmarks you need to beat to invest. And that's what the 9.95% becomes to me, is the hurdle rate I need to beat as an investor in this stock for it to be a good stock. This is why when you do valuation, this same number is going to come in as a discount rate to use to decide, is this a good stock for me to buy? So from the investor perspective, the expected return you get from the CAPM becomes a hurdle rate, the rate you need to make on a stock for it to be a decent investment. But let's turn the tables. You were investors, I was the company, right? I'm the CFO of Disney. What does this hurdle rate become to me? If you as equity investors need to make 9.95% just to break even, not even to be happy, guess what I have to do? I have to try to deliver a return on the equity invest in this company that at least matches the 9.95% and hopefully makes more for you. So the same required return that you look at becomes my cost of equity. People often talk about the cost of equities as abstraction. It's really the return equity investors need to make to break even. 9.95% becomes my cost of equity. We do this in corporate finance all the time. But implicit in this statement is an assumption about what managers care about and look at. And let me explain. It was a long time ago, probably 15 years ago. I was talking to the CFO of one of Asia's largest companies. I won't name the company. And he says, he asked me, what do you think my cost of equity is, out of the blue? Now, I hate to hazard a guess, but I said, you know what? I gave him in the local currency, I think it should be about 11%. He said, it's not. I said, what the heck do you ask me this question if you already know the answer? He said, it's only 2%. I said, what? The risk-free rate was like 5%. How can your cost of equity be 2%? You know what he viewed as his cost of equity? What's your only number you have to deliver to your shareholders? The dividends you pay, right? He was taking the dividend yield on his stock and saying, only a 2% dividend yield. My interest on debt is 9%. My dividend yield is 2%. Equity is cheaper than debt. I said, that's not true. Your cost of equity is not your dividend yield. In fact, how would I explain the difference between the 2 and the 11 that I got? What's the extra 9% I'm building in my cost of equity that he wasn't building into his cost of equity? It's the expected price appreciation. Nobody buys stock just to collect the dividend, because if your stock price doesn't go up, you're going to underperform. I said, you need to deliver at least a 9% price appreciation on an expected basis And then he said, what if I don't? Do you see where, what his argument was? When I borrow money at 9% and I don't pay the 9%, what happens to me? I go bankrupt. When I raise equity, people might think I'm going to deliver 11%, but if I deliver only 2%, I'm not going to go bankrupt. They can't legally sue me. So I told him what might happen, which is, if you're a stockholder, you buy stocks in a company, shares in a company where you expect to make 11%, they consistently deliver only 2%. What are the two things you do? What's the first thing you do? You're disappointed, and when you're disappointed, you sell. You push the price down. So I said, your stock price may go down. He said, I don't care. No, seriously, he said, I don't care. We don't plan to go to the market. We're a mature company. So what if our stock price goes down? So then I hit him with what I thought was my key argument, which is, if you as shareholders keep seeing this performance year after year, managers are delivering only 2%, they need to deliver 11%. What might you plan to do to the management? So, want to replace you. I said, well, they might get, I use the argument of that critical mass of getting pissed off. They'll get pissed off enough, they might replace you. He started laughing. He said, do you see the last name on he had this big board in front of him. See the name on the company? I said, yes. He said, don't you notice their match? I said, I do. It was a family group control company, and he said, we're not worried about turnover. There's nothing shareholders can do to us. What this long-winded story is trying to bring across is we talked all that time about corporate governance. Where does the power lie? It sounded like an abstraction, but for this 9.95% to be viewed as the cost of equity, managers have to be scared enough about what will happen if they don't deliver price appreciation. If they're not, guess what they're going to do? They're going to view equity as essentially a cheap or even a free resource. Because remember, if you pay no dividends, in this guy's head, what's the cost of equity? 0%. Corporate governance is not a side story. It drives how you think about required returns and cost of equity. And I'm going to assume that this is the cost of equity for your company, but I'm not going to be surprised if you're a family-controlled company with your own agenda if you keep delivering less than this return. Because you feel protected. If you get a chance, visit my blog, because yesterday I posted about returns at companies relative to their cost of capital. So cost of capital is your hurdle rate. In 2021, which was a pretty good year for companies in terms of profitability, 57% of companies globally were delivering returns that were less than their hurdle rates. It sounds weird. It's not that they're losing money, they're just not making enough money. And that was with historically low hurdle rates. We have lower cost of equity and capital now than 10 years ago. 57% of companies are delivering less. And some of them are companies run by people like this guy saying, hey, what if I deliver only? It's not that they got surprised. It's what they're building in is a return that's actually lower than the hurdle rate because they don't view that as what they need to make. So here's what I want you to do, is I want you to get the beta page printed off for your company. If you don't want to do that on Bloomberg, you can do your Excel regression. I'll send you the way to do it. But since you have access to Bloomberg Anywhere, get on Bloomberg Anywhere. I sent the instructions for that. I'll send it again. Print off the beta page for your company. It's just one page. Yeah? And it'll look exactly like my Disney page, but I want you to go through that regression page, starting with, hey, how good or bad was your stock? So if you want to use a 2-year weekly, which is the default on Bloomberg, stay with it. That's fine. But was your stock a good or a bad investment after adjusting for risk in the market during the period of your regression? So start with that. Then I'm going to ask you, what proportion of the risk in your stock comes from the market? So what's the number you're going to focus on for that? You're going to look at the R squared. And I'm going to ask you, what's your historical estimate of beta, which is the raw beta? So don't even look at the adjusted beta. It's kind of pointless. And then follow through. The standard error is right there. What's a 67% range? What's a 95% range? Take your regression beta page apart and get a sense of what does it tell you about your company. And once you've done all of that, assuming you've done the other stuff I've been nagging you about, You have a riskless rate in the currency of your choice. You have an equity risk premium based on where your company does business. You now have a beta. You can do exactly what I did for Disney for your company. Come up with a hurdle rate, a cost of equity for your company, and a required return for investors looking at your company. Any questions on that regression beta page? So now let's carry this to the next step. So let's assume you're doing this on company after company, risk-free rate, beta, risk premium. I'm going to play the role of the CFO of a technology firm, and you're my banker. And because you're my banker, I ask you, well, what should my cost of equity be? It's a dangerous question to ask a banker, but I ask you that question. You're my corporate finance advisor. So you go and collect the risk-free rate, you collect the beta, you collect the equity risk premium. Let's say that I am, the beta you come up with for my company, because I'm in a very risky business. We'll see why some companies have really high betas, is 3. So what does that mean? I'm 3 times more risky than the average company, right? So when you think about my cost of equity, it's risk-free rate plus 3 times the equity risk premium. The cost of equity you come up with is 20%. So you come to me and say, your cost of equity is 20%. First, as a CFO, do I want a high cost of equity or a low cost of equity? I want a low cost of equity, so I'm disappointed. So I ask you, why is my cost of equity so high? You say, because my beta is 3, I know. But I want to dig a little deeper. What's causing my beta to be high? And that's what this question's about. Because I don't like that beta. So you show me this the beta of 3, assuming you've done it right. And then I ask you, is there something I can do? Because I can see that's what's causing my cost of equity to be high. Is there something I can do to bring my company's beta down? So I want you to think about things I can do as a company. So you've told me why my cost of equity is high. It's because I have a high beta. I want you to start thinking about things I can do as a company to bring that beta down. Any ideas? Go ahead.
So like, is there like, if it's like Tesla, like, Elon Musk stop using Twitter, for example.
That's company-specific risk, right? Because in a sense, Elon Musk uses Twitter. Remember, it's been a plus and a minus for the company. There are times he's pushed the price up. So company-specific things are going to do very little for me, for my beta. They might reduce my company-specific risk. Yes?
Want to mirror like a competitive set to see what other companies in the software industry are doing and why you're not?
Okay. Maybe they have high betas too, but part of this is saying, is this coming from the business? If I'm in a risky business, they all have high betas. So let's assume that's the case. I look at the software companies, they all have high betas. My business is a risky business, right? So what's an easy way to make your business less risky? It might not be a sensible way, but an easy way.
You could acquire a company in another industry.
You could go buy a utility, right? No software company wants to do that. But if my objective becomes, I want to bring my beta down, I can try to get into safer businesses. Microsoft actually found a way to make its beta come down without getting into safer businesses. Microsoft, if you look at its history through 2013, was a software company. It made money on the next upgrade, right, to Office or Windows. And the problem when you're a software company that lives off upgrades is it's feast or famine. The upgrade goes well, a lot of people upgrade, you make a lot of money. If they don't, you don't make much money. What did Microsoft do to change that business? They went to a subscription model. Today, when you buy Office or Windows, Office at least, it's through Office 365. What does the subscription model do? It replaces this lumpy revenue stream. You get ups and downs with a more stable, it's what, $79.95 a year, $99.95 a year. So one thing companies might do is change the way their business is run to make the business less risky. So that's the first thing. So I'm glad none of you said, why don't you go back to the Bloomberg beta page and change the index? Because that's cheating. That's not changing your beta. It's just making your company look safer. So first is you can try to become a safer business. In fact, if you want your beta to be 0 tomorrow, I can pull that off. You know what I'd do? I'd liquidate your entire software business and put all the money where? In T-bills. Not in the market, because then the beta will be 1, right? Because you'll be putting in the end. I'll put it in T-bills. It's a stupid thing to do, because nobody wants a money market fund as a software company. But if my objective becomes I want to bring the beta down, first thing I can do is try to make my business safer. The second thing I might try doing, if I have any debt, is to pay off the debt. Do you see why having debt can push up your beta? Because when you have debt, you got interest payments, they make your earnings much more volatile. So the second thing I can try to do is to bring my debt load down, which for a software company is not going to give me much play because most of them have very little debt. So I can make my business safer by trying to change my business model or buying a safer business or even liquidating a portion of my company. I can try to bring debt down. And there's a third thing I might try. We're going to talk about this notion called operating leverage. You know what operating leverage is? The proportion of costs in my business that are fixed costs. And here's the rationale. When you have a lot of fixed costs as a company, your beta tends to be higher because, again, good times get great and bad times become awful. If there's something I can do to bring my cost structure, make my cost structure more flexible, more variable cost, less fixed cost, that's going to lower my beta as well. You know, one of the big trends, especially over the last 20 years in the US, is outsourcing. Think of what outsourcing does. It takes a cost that used to be a fixed cost in your company, and it makes it a variable. I'm not saying this is a good thing to do necessarily, because there might be effects on your earnings and cash flows. But if you think purely in terms of risk, replacing a fixed cost with a variable cost is going to lower your beta as a company. We're laying the foundations for thinking about what it is that drives betas. We're going to come back to this and talk about those things, the business you're in, the debt you have, and your fixed cost structure. And that's what I want you to start thinking about. Don't think of betas as something that come from a regression or from a service. They come from choices you make as a company and how you run your business. So I'm going to mop up by looking at the betas for the other companies. Remember I have Tata Motors, and so let's start by looking at the beta for Tata Motors. So here's the beta run against the Sensex. Why? Because Bloomberg default is always the local country. We'll talk about whether this is sensible or not, but that's what Bloomberg does. Again, let's look at the output. The beta was 1.83, that's a raw beta, with 67% confidence, or plus or minus the standard error, which is 0.16. The range on that beta is 1.67 to 1.99. To the extent that I trust the R squared, 69% of the risk in Tata Motors comes from the market, 31% is company specific or market or firm specific. My Jensen's alpha, my Intercept is 2.28%. The average risk-free rate on a monthly basis in India during the 5 years of this regression was 4%. And I divide by 12 because I use monthly returns. Incidentally, if you're doing weekly returns, don't divide by 12, divide by 52. You want weekly returns and the weekly risk-free rate. Times 1 measure. So my Jensen's alpha here is 2.56% a month. If that doesn't strike you as impressive, if I annualize the 2.56%, I get a Jensen's alpha for Tata Motors of 35.4% a year between 2008 and 2013. This can't be explained away by the automobile sector doing well. There's something that Tata Motors did right during this period that explains these huge Jensen's alphas. You know what Tata Motors did between 2008 and 13 that explains this Jensen's alpha? It's one big action they took. Yeah. They bought Jaguar Land Rover. Usually acquisitions are a terrible idea because you overpay. Luckily for Tata Motors, they bought Jaguar Land Rover at the right time from the right seller. They bought Jaguar Land Rover in 2009, right time because people had given up, right? There's crisis from Ford, which is desperate to just get rid of Jaguar because they thought it was a money loser. They paid a bargain basement price, and it saved them as a company. Without Jaguar Land Rover, I don't even know where Tata Motors would be today. Because in the domestic market, as a mass market automobile maker, Tata Motors has had a really tough time over the last decade. Jaguar Land Rover has bailed them out. When you get huge positive Jensen's alphas, I want you to stop and ask why. Sometimes you might not be able to get the answer, but often you can say, this is what they did. In either direction, positive or negative, try to isolate what it is about your company that allowed them to deliver that Jensen's alpha. And finally, if I plug the numbers in, risk-free rate, if you remember, is the Indian rupee risk-free rate, which is the government bond rate, net of the default spread. The beta, 1.83, raw beta. The equity risk premium is the weighted average of where Tata Motors gets its revenues. You know what Tata Motors' biggest market was geographically last year? It wasn't India, it was China. Because Jaguar Land Rover has a big presence in China. It's amazing how companies' geographical distribution can change over time. So 19.73 would be my cost of equity in rupee terms for Tata Motors. Now with Vale, I ran 2 betas. Why? Because you can run a beta for Vale against the Bovespa, which is the local listing. You can also run a regression of Vale ADR, which is the listing they have in the US in dollar terms against the S&P 500. I get 2 very different betas, 0.89 or 1.37. Saying which one should I use? I don't trust either one of them. In fact, I could run 5 different regressions against different indices. But this is something I want you to be aware of, is you can sit there with the company and then run these multiple regressions against different indices, different periods, and you're going to get very different betas. Remember I said I'm digging a hole to bury regression betas? Here's the other reason you don't want to trust regression betas. They're very much a function of the choices you make about the index, the period, the way you compute returns. And just to show you how your index choice can make a difference, I took Deutsche and I ran 2 regressions, one against the DAX and one against the FTSE Euro 100. Both legitimate indices, right? Because it's a German stock, but it's also one of the biggest, at that time, one of the biggest stocks in the Euro index. I get, again, different betas, different standards. Don't pick statistically. You know what I mean by that? Statistically you're taught higher R-squareds are better than lower R-squared. That is not the case with regression betas because it's a function of what the index is. Against a local index, you will often get a much better looking R-squared, a higher R-squared, than if you run it against a global index. In fact, I started this class by telling you I was going to run the regression for Disney against the S&P 500. For Deutsche against the Euro index. For Vale against the Bovespa. But none of that makes sense, right? Because you think about the investors in these companies, they're not investors who are just US investors or Brazilian investors or German investors. I bet, if you look at all 3 companies, that BlackRock is probably among the top 3 holders of all 3 companies' stock. As investors become more global, if I were a beta estimation service, you know what I should be doing? If your investors are global and they think about risk, they don't think about risk against local indices, they think about them against a global index. No service has gone there yet because, again, inertia drives this process. But I'm surprised that they don't at least have an option saying, we've estimated the beta for every company against the MSCI, which is a global index, because that makes more sense given that marginal investors are becoming global investors. Next class, when we start, we're going to go back to the drivers of betas. We're going to look at the fundamentals that drive betas. But before we do that, if you can print the beta page for your company and start doing the diagnostics, then on Wednesday, when we think about the drivers of betas, you can look at your company and say, why does my company have a high beta, low beta, or an average beta? Because that's key to understanding and using betas better. I will see you on Wednesday.